Thank you.
Good morning, everyone. Thank you so much for joining us for the third conversation of the day. This one is on financing Africa's future. We're looking at growth, innovation, and stability. We're having this conversation in the context of Africa's growing debt pile. It's set to top $1 trillion this year. It also comes at a time when capital has become far more selective. We're seeing constraints globally that we're all aware of. And what it means for countries on the continent is that they're having to navigate tighter financing conditions just when we need more capital and not less to industrialize, to build resilience, and to sustain growth. Notwithstanding these difficulties, there are a lot of windows of opportunities. Just yesterday, we had the CEO of Rand Merchant Bank. She's speaking about Africa being the fastest growing population. By 2029, we'll have 1.1 billion users. By 2030, the agribusiness sector could be worth $1 trillion. And so there's no doubt as to the growth trajectory of the continent. What we're really concerned is how do we get there? And so I want to start with you, Jeremy. You operate in more than 30 markets on the continent. And I'd like to know, can banks keep pace with Africa's financing needs without taking on unmanageable risk?
The financial sector has to work together. I mean, we know when we look at things like infrastructure financing, the gap is 150 billion, right? When you look at lending into SMEs, there's a gap of 300 billion, right? So as we look at this, I think it needs a partnership approach and different players to take their role in helping finance Africa's development. So we've got the DFIs who can come in and play a role in bringing capital from outside to actually finance some of the longer-term projects around infrastructure, road, rail, ports. The banks and financial institutions can come in and play a role at financing the domestic businesses that participate in that building. The banks can also finance private sector growth from that perspective. So I think if we all come in and play our part, we will be able to make progress. One of the things that I think we need to do more of is we need to mobilize more of Africa's own domestic capital in 2 or 3 areas. One, we need to mobilize more domestic savings on the continent. It's about $4 trillion. But when you look at the Africa savings rate relative to other parts of the world, it's in the teens, and it needs to be at a higher level. That will allow us to then use that to lend into the real economy. The second is that Africa's banking capital, especially tier 1 capital, is very low as a percent. The top 100 banks' capital on the continent is approximately $126 billion. That's less than a single bank in the US. I won't mention the banks, but just gives you a sense of perspective. And that constrains the amount that we can lend. So I think we need to look at sovereign funds, pension funds, investing in the core capital of banks on the continent, and then we now lend that into the real economy, into corporates, SMEs, and individuals over time.
SG, there's consensus now around investors mispricing African risk, and that obviously constrains access to capital. Is there any work that we could be doing around tapping new instruments, your green bonds, your blended finance? What is the sort of work that you've been doing along with stakeholders in that regard?
Well, thank you very much. Let me thank Bloomberg for convening us here today. The cost of debt in Africa is estimated to be 20 times more than a Western European country, let's say Germany or whatever. And of course, that cost is transferred to us citizens. There are my own personal view is that the risk perception is not based on reality. It is unfounded, which, as you know, and this is underlying the point of your question, that is what drives the cost of the debt is the risk premium. I think that the solution is in exactly what Jeremy just said, in mobilizing our own domestic capital to invest in Africa, whether we are investing in infrastructure, in SMEs as an asset class for investment, for us to overcome this issue of the cost of debt, certainly mobilizing domestic capital is key. Just last week, we had one of the largest industrialists, one of the foremost industrialists in Africa saying that one of the ways to reduce the cost of debt is by African governments enabling African investors to invest more and creating a positive investor climate. And then those who are foreign investors will also have the confidence to come in and invest. And so I think my view is that this issue is going to remain with us for some time. Let us focus on mobilizing domestic capital. By domestic, I mean development finance institutions who have the balance sheet to mitigate risk, to provide platforms for risk optimization mitigation. AfCFTA, African Development Finance, African Development Bank, Africa 50. These are Trade and Development Bank of Africa. These are institutions that have the capacity to provide further support to our commercial banks. And so the blended finance tool, I believe, is something that we should intensify. There are areas where we have begun to see that. For example, in climate finance for Africa, we have begun to see more and more cooperation and collaboration and syndication between development finance institutions and commercial banks for investment, deploying capital to mitigate climate change. So I think given the state of the world and given the current global environment, we will continue to face overpriced risk premiums as a continent.
So if we can get the Africa Continental Free Trade Area correctly, it would be the biggest in the world by number of countries, right? But there's a lot of challenges, and I know, Jeremy, you're far more forgiving of some of the criticisms around that trade area. You've offered some support in terms of finance and from a payment perspective as well. Maybe you can touch on that, but also on the policy side, given that credible policy making is so critical to investor confidence. You've had some engagements with governments around some of the non-tariff barriers that you're worried about. Maybe you can just give us some insight into what that response has been like.
One of the biggest challenges we find is, we operate in 34 countries across the continent, is every country has its own legal framework, its own regulations, its own approach to things. And I think there's still room for us to imbibe a mindset of Pan-Africanism. I think we say it in words, but we don't act it out practically. And we need to understand that we are a much more potent force if we consider ourselves 1.5 billion people than if we consider ourselves as the number of people in that country. And I see this day to day most specifically for smaller countries. We've got countries where there are 300,000 people, the entire country. How are they going to compete against countries which have 200 million people? So by changing our mindset around how do we create regional markets that are attractive enough for investors to come in and have the scale to consider us as consumers, then they will invest in things like value-added manufacturing, manufacturing for the local market as opposed just to the export market for the developed world. So I think that's one. Second, we have to look at the policies and frameworks that exist. Small differences can make material change. So if I take infrastructure, if you take the rail network, if you've got standard gauge railway, might be a 1 meter track. But if the next door country decides to take a 0.8 meter track, the two cannot connect, which means you have to bring the goods to that point offload them and load them again. This is just completely inefficient. So we have to look at some of these and make sure there's proper coordination, and that's where His Excellency Wamkele is looking at this and saying, when we're thinking about the movement of goods, how do we enable it? We as a bank, we're working with the Secretariat, we're working with AfCFTA around bringing buyers and sellers together on digital platforms. So we have our One Trade Hub that actually enables people to say, I'm looking for these goods, these are the suppliers of the goods. We're working on payment mechanisms where we can do payments for small traders, because we always think this is about big trade. There's small traders between borders, like if I look between Ghana and Togo, you see the people moving across the border. There are many, especially women, but they're carrying cash, right? Why aren't we paying digitally? Why aren't we got tap and pay? They know what they're doing, or send it electronically without having to worry about, now what's the foreign exchange rate here, and how do I move that money across? So even when we think about infrastructure, we need to think about payments, effective, cheap payment mechanisms to enable that. And then there's all the general bureaucracy, which I think we're all familiar with, whether it's ports, whether it's moving goods along road or rail. So those are the things which we are talking and trying to get very specific about. And my philosophy is let's pick countries that are willing and start with those, right? You know, those who neighbor each other are the best place, rather than saying, how do I move things from Uganda to Senegal is much more complicated than if you're talking Uganda to Tanzania or Kenya to Tanzania, right, where it's only one border.
I want to be fair to you. I've said that there is some criticism. How are you taking that, first of all? Do you feel like you're making any real progress? Obviously, the establishment happened quite quickly, but the implementation, we're seeing some challenges. And how do those look, given that we have this target of 2035, where you want full implementation?
Well, I think that there are constraints that are trade policy related. And then there are constraints that are outside of trade policy. Let me start with the constraints that are outside of policy, of trade policy. First, as Jeremy was saying, the cost of infrastructure. Infrastructure deficit between $120 and $150 billion annually. The cost of transport and logistics. The inability for business persons to move freely in the continent. This is a very, very high cost for trade in Africa, as well as the fact that we have 42 currencies. If we are in Ghana, where I live, Jeremy is right next door. In Togo, when I travel to Togo, I have to buy the dollar. So we have these constraints that have an impact on the extent to which goods and services can move freely or not. We have to address those very, very specific challenges. The heads of states, the ministers of trade, ourselves, we now have a trade agreement that is being implemented. The trade rules were negotiated. The trade rules are there. I think that given the current climate around the world, the direction that we're going is a very positive direction. I just made an example yesterday in Abuja that Nigeria, Africa's largest economy, the number one export destination now for Nigeria is the African continent, on the back of the liberalization that has been undertaken. So I think from a trade policy point of view, certainly there has been a lot of progress. But as regards externalities, there is a lot of work to be done. I mentioned these constraints, the cost of transport and logistics, the cost of infrastructure, the cost of trade finance, particularly for SMEs. If Jeremy and Ecobank, if they don't take the risk to lend more, who's going to protect their shareholders? Again, the issue of risk mitigation comes in. And then we have other factors. How do you Trump-proof trade policy? How do you Trump-proof macroeconomic stability? That has an impact on intra-Africa trade. So as much progress as we've made in trade policy and having harmonized rules, there are externalities that we have to focus on. And just a final point on this issue, we have been fragmented for almost 70 years as a continent. I do understand the sense of urgency that we must move fast, but we have to also be mindful how deep this fragmentation in our continent is. 42 national switches for payments. That is incredible. So that means that it is much easier for us as a continent to trade with outsiders than it is internally as a continent. So we have a lot of work to do. The legal foundation is there through the AfCFTA, but much work needs to be done for us to increase intra-Africa trade as a contributor to overall economic growth and development in our continent.
I just want to stick with you on political volatility that we have on the continent, right? I think since 2020, we've seen at least 8 successful coups. Yeah. And I wonder realistically, how much work can you do to bring about some kind of regulatory predictability for the investment community that's looking to make inroads on the continent?
The coup d'etats, we unfortunately are regressing. In the part of the world that we live in West Africa, it is Guinea, Guinea-Conakry, Burkina Faso, 2 coup d'etats, Mali, 3 coup d'etats. But the AU has been very, very clear to say unconstitutional changes of government are totally unacceptable. From a market point of view, if you look at what's happening in Niger now, inflation in double digits, the country regressing in terms of development, the cost of debt much, much higher, the standard of living of people has significantly lowered. Similarly, in Burkina Faso. In Burkina Faso, the junta controls only 30% of the country. The rest is in chaos. And so I think that the impact of these unconstitutional changes of power, of course, we can't underestimate it. However, the African continent is not one big coup d'etat, and it is not one big conflict. There are very, very positive and compelling success stories of stability, of economic growth, of innovation technologically, and we have got to focus on those positive aspects and positive attributes of our continent, particularly from an economic point of view. We know that of the 10 fastest growing economies in the world, 6 or 7 of them are here in Africa.
Jeremy, I want to riff off of something that the SG mentioned earlier, and that's Nigeria. On the other side of the bad politics, we've seen some really tough reforms there over the past 2 years. Initially, there was a bit of turbulence, and we're seeing some stabilizing that's happening there. It's one of your key markets, where others would have thought, okay, things are not looking great now, let's run away. You've stuck around. I just want to understand more of the resilience on that front. You've had some challenges there, maybe you could speak to that. And really, what is the role of reforms in building investor confidence?
Like I think was mentioned, when people or businesses look to invest in countries, they're looking for a level of stability. They're looking for predictability, whether it's from a policy perspective or a regulatory perspective or a tax perspective. When there are sudden changes, then it becomes very difficult. You end up with things like parallel exchange markets, as we saw. And I think we've seen a lot of reform that's happened in Nigeria from a policy perspective. We saw the approach taken to exchange rates. And that we've seen the Naira, for example, being much more consistent. We've seen an opening up of outbound flows becoming stronger, which supports the export of Nigerian goods out there. We've seen, obviously, the investment in the refinery by Dangote really easing that pressure around importing refined products, again easing the exchange and reserve positions. We've seen inflation coming down because of the policy rate, so it's come down from, above 30% to closer to 20%. So we're seeing this being reflected, and I guess the likes of S&P and others have now upgraded, the country. But by no means is this battle over, right? We need to make sure that we have an environment that is positive and open for business, that encourages people not to hoard. So if people are unsure whether they can get dollars to repatriate their profits, then they start buying more than they possibly need, which starts creating problems. But I think from our perspective, I think that the trend has been positive. It hasn't always been easy. Sometimes, to heal, you need to have tough medicine, right? And I think we're on the way. I mean, for us, if that can continue, the predictability will be there. We need to see the economy really investing in driving up economic growth, driving up employment. Because the reality is we have young populations. And we've seen, if we do not create growth and we do not create jobs and we do not create livelihoods, they will take matters into their own hands. You just need to look at Madagascar. You need to look around the continent. So governments need to be on alert that we have to address the economic realities of these countries if we're going to keep that stability. Going to what His Excellency Wamkele was saying, if you end up with turbulence, businesses will go elsewhere. We forget, when we go to the global stage, Africa is often not in the conversation, if we're honest. We are in this conversation because we are friendly to Africa or we're Africans. But out there, as a percentage of global GDP, we're not a big player. And there's other realities. So we need to create these environments where we invest in Africa ourselves, right, before we start thinking elsewhere. And we create an environment where business can be done effectively. And we give great returns. That's what people forget. We give great returns in Africa that people will want to be part of. And then they will come in to now invest themselves.
We're just about out of time, but I want to give you the last bite, Jeremy. For the next decade of financial growth, what are you most looking forward to?
I think the innovation that is going to come out of Africa is going to be outstanding. We have the opportunity to leapfrog. We don't need to go through the stages that other countries have. And I think if we're humble enough to look at what other markets have gone through, in particular in Asia where they've been successful, blend that with looking at the technological advances that are necessary for us to be able to create economic growth and opportunities for young people, I think Africa can be relevant. All the social demographic statistics are in our favor. But we have to prepare for that future in every way, from education, social services, technology, infrastructure. Then we will be the continent that transforms over the next decade.
On that note, gentlemen, thank you for being here this morning.
Thank you.
Thank you so much.